All right, so um, it's useful to have a way to sort of measure how much of an oligopoly is like a monopoly in a sense. How close is the industry to being a monopoly? If it's not, right, if there's more than one firm, well, how close is it to being that? And we can use something, there's different measures. One of them is called a concentration ratio. And this is simply calculated as the percentage of all sales contributed by the leading 4 or sometimes the leading 8 firms in an industry um, as a ratio compared to the industry sales as a whole, sometimes called the industry concentration ratio. Okay, so basically the way that this would be measured is, let's say that there are 4 of the firms in the industry account for 80% of the sales in the industry. That would be the concentration ratio for that industry. 80% of the top 4 firms' sales comprise the entire industry's sales, right? So here's some examples of concentration ratios for the U.S. broadband service industry. Okay, so here we've got, let's see, 5 of the top broadband service providers. Comcast accounts for almost 24% of the industry's sales, followed by AT&T with just over 17% of the industry sales, followed by Time Warner Cable, which accounts for over 13%, Verizon, which almost accounts for 10% of the industry sales, and then Cox, which almost accounts for 6% of the industry sales. Now, if you added all these up, it wouldn't quite add up to 100, which means there are other businesses in this industry that we're not seeing here. But if we were to calculate the 4-firm concentration ratio for the industry, we would add up the percentages of the top 4, and that comes out to be 64.1%. So pretty high, not as high as it could be, but this industry is pretty concentrated, right? 64% of the entire industry sales go to the top 4 firms. Okay, so pretty concentrated. Here's another example. So firms 1 through 4, their annual sales. So this is giving us sales figures rather than percentages like we saw on the last slide. So firm 1 accounts for 150 million of the industry's sales. Firm 2 accounts for 100 million, 80 million for firm 3, 70 million for firm 4, and then 50 million for the remaining firms 5 through 25. So as a whole, the industry has 450 million in sales as a whole for the industry. The top 4 firms account for 400 million of that 450 million total. So the 4-firm concentration ratio in this case is calculated as 400 divided by 450. So 400 is the top 4 firms' sales divided by 450, which is the total industry sales, and that gives us almost 89%. So this would be more concentrated than the previous example we saw with broadband services, where it was around 64% concentration. Okay. And here's a table of some different industries and their concentration ratios, the top of the top 4 firms. So cigarette companies, the cigarette industry, highly concentrated. The top 4 firms account for almost the entire industry. There's only 2% of sales conducted by firms other than the top 4 firms. So highly concentrated in the cigarette industry. Breakfast cereals, pretty concentrated as well, at a concentration ratio of 80%. Some other interesting ones, soft drinks, not as concentrated as I would have guessed, actually, especially with Coke and Pepsi being the top 2. I would have thought that they would be much more concentrated than only 58%, but nevertheless. Commercial banking, also not as concentrated as I would have guessed, but there you go, some interesting examples of different industries and their concentration ratios. Now there's an alternate measure of concentration other than the concentration ratio. It's called the Herfindahl-Hirschman Index. Now, I don't expect you to calculate this one. You might be asked to calculate the concentration ratio. You won't be asked to calculate the Herfindahl-Hirschman index, but you do need to know what it is. Okay, so it's equal to the sum of squared sales shares of all firms in the industry. Now, actually, I don't even expect you to remember that, okay? I just want you to know how it's different from the concentration ratio and how it might be a little bit better. So first, we're going to look at the table in the next slide and show that the concentration ratios can fail to reflect potentially considerable variations in the distribution of firm sizes within industry. And I'll show you what I mean by that. Okay, so here we've got industry A and industry B. Both of them have concentration ratios of 80, right? So here's the top 4 firms. Their sales add up to 80 million, and there's 100 million in each industry. Same thing here. So adds up to 80 million in sales. Here's the share of sales. So actually, I'm sorry, I misspoke. The concentration ratio is not 80, it's actually 100 because these firms account for the entire industry. So, but the difference here is that while the 4 firms account for the entire industry, and so their concentration ratio is 100, in this case, firm 1 is much bigger than the other 3 firms, where in this case, all 4 firms are equally sized in terms of their sales, right? So if you look at the sales share percentage, right, firm 1 in industry A accounts for 81% of sales, and the other 3 account for only 6%, 6.25% of sales. Whereas in industry B, it's equally split amongst the 4 firms, so each firm accounts for 25% of sales in that industry. So the concentration ratio for both of these industries would be the same, 100 or 1, if you're looking at it as a decimal rather than a percent. But clearly these industries are much differently concentrated, right? This one is concentrated much more in the top firm, whereas this one is evenly split amongst the top 4 firms, and so it's not as concentrated, it's kind of more balanced, right? So this is where the Herfindahl-Herschel, sorry, how do you say it? Herfindahl-Hirschman, rather, index, the HHI, comes into play and is much better. The HHI here, you'll notice, is much higher than the HHI here, and it's because the concentration of sales is much more concentrated in a single firm rather than in this industry where it's sort of, there's a better balance and it's not as concentrated. So this is where the HHI kind of has an advantage over just the plain old vanilla concentration ratio. So that's what you need to know. You just need to know basically that the HHI is a slightly better measure of industry concentration than just the plain old concentration ratio. Right, and then this is just a summary of what I just said, right? All right, so looking at the HHI, recently the worldwide percentage shares of sales for the top firms selling tablet devices were Apple, Samsung, Lenovo, Huawei, LG, and Asus. And so basically the way that you would calculate this, even though I'm not asking you to know this, is you would just square each of these for the top 4 firms, right? You would take this squared, and this squared, and this squared, and this squared, and add them all up, right? That's how you would calculate the HHI. And so for this industry of tablets, the HHI is approximately 990.